Now speaking, Pedro Zinner, Chief Executive Officer. In the second quarter, we saw strong growth in our commercial performance and made progress in improving our services and operations. Financially, we exceeded our expectations, with total revenue reaching 3 billion reais, a 28% increase year-over-year. Adjusted EBT reached 447 million reais, the highest in our history, and adjusted net income grew 5.8 times year-over-year to reach 322 million reais. We also focused on generating cash, with adjusted net cash increasing to 4.3 billion reais. Our financial services business showed healthy growth, with MSMB TPV increasing 19% year-over-year and a net client base growth of 204,000. We expanded our banking solutions with the launch of debit cards and are piloting credit cards for Stone clients. In our software business, we improved our results with revenue reaching 383 million reais and a 17% adjusted EBITDA margin. We also made important organizational changes, welcoming Mateus Scherer as our CFO and Iro and Roberta Noronha as our head of investor relations. We are excited to host our first StoneCo Day in New York this November to share our views on the business and our future growth plans. Now, I'll pass it over to Leah for a discussion on our performance and strategic updates. Now speaking, Leah Matos, Chief Operating Officer and Chief Strategy Officer. In the second quarter of 2023, our financial services segment saw a 32% increase in revenue to 2.6 billion reais. This growth was driven by our MSMB client segment, which experienced above-industry TPV growth, higher take rates, and an increase in our client base. Our MSMB client base reached approximately 3 million active merchants, with a quarterly net addition of 204,000 clients. MSMB TPV increased to 83.3 billion reais, a 19.3% year-over-year growth. Our take rate also improved, reaching 2.48%, an increase of 9 basis points quarter-over-quarter and 38 basis points year-over-year. We de-emphasized low-margin sub-acquirer volumes, resulting in a decrease in key account TPV by 32.5% year-over-year. However, key account take rates increased by 28 basis points. In our banking segment, our active client base grew 3.2 times year-over-year to reach 1.7 million merchants. Total deposits reached 3.9 billion reais, with a slight increase quarter-over-quarter. We launched new banking products, such as debit and credit cards, and are working on enhancing client experience and integrating our banking solutions with select ERPs. In our software business, revenue increased by 9.2% year-over-year to 383 million reais. Software adjusted EBITDA increased by 25.1% year-over-year to 66.5 million reais, with a margin of 17.4%. We reduced headcount and made organizational adjustments to drive efficiency gains. We are prioritizing cross-selling opportunities between financial services and software and are working towards building an end-to-end platform. We will provide further details during our StoneCo Day in November. Now speaking, Mateus Scherer, Chief Financial Officer and Investor Relations Officer. In our latest earnings report, we saw a strong performance in our costs and expenses. Cost of services increased 9% year-on-year, but decreased as a percentage of revenue. Administrative expenses also decreased as a percentage of revenue, thanks to efficiency initiatives. Selling expenses grew, but decreased as a percentage of revenue due to lower marketing investments. Financial expenses increased due to growth in prepaid volumes and a conservative cash balance. Other expenses decreased, primarily due to lower tax provision. We also experienced strong cash generation, with adjusted net cash increasing by 338 million reais this quarter. Looking ahead, we expect total revenue and income to exceed 375 million reais in the third quarter, with year-on-year growth of over 22.6%. We anticipate MSMB TPV volumes between 87 billion and 88 billion reais, representing a year-on-year growth between 16.5% and 17.8%. Additionally, we expect adjusted EBT of more than 470 million reais. Please note that this is the last quarter we will be providing quarterly guidance, as we will be transitioning to a longer-term outlook during StoneCo Day in November. Evercore IC analyst Sherrick Summer inquired, can you provide an update on the competitive dynamics in Brazil's payment industry? Specifically, have you observed any growing competition from foreign countries, particularly the US? Additionally, within Brazil, how would you describe the current competitive landscape and where have you experienced the most significant market share gains? Leah Matos replied, in terms of competitive dynamics, we have observed a consistent trend this quarter, similar to previous quarters. Our group has continued to lose market share, albeit at a slower pace. However, we have noticed a shift in market share among the top players, particularly towards larger clients. Our ability to react to these dynamics is supported by our comprehensive understanding of local market dynamics and our hub operations. We have seen positive results in gaining market share in the MSMB segment this quarter, and we anticipate this trend to persist in the future. Evercore IC analyst Sherrick Summer inquired, can you provide insight into the potential stabilization and long-term sustainable margin for the software EBITDA segment? Mateusz Shearer replied, in the software division, we saw a 7% improvement in top line during the quarter, driven by new sales. We were able to maintain control over costs and expenses, with slightly higher capitalization of R&D expenses offset by severance costs related to a reduction in headcount. This reduction had a one-time negative impact on our EBITDA of 6.5 million reais, but it is expected to result in savings of around 10 million reais per quarter going forward. Looking ahead, we anticipate continued top-line growth and improved margins in the software division due to our cost discipline and savings measures. Scotiabank analyst Juan Recalda inquired, how much of the 340 basis points improvement in operational leverage on the cost of services was driven by the change in R&D? Mateusz Shearer replied, in the quarter, we made two adjustments related to the capitalization of intangible assets, which impacted our cost of services. Firstly, we standardized our software segment capitalization process to align with our financial services units. Secondly, we identified additional projects in our tech team that were not previously capitalized, specifically related to new features. These adjustments resulted in a one-time positive effect of $21 million on our quarterly cost of services. However, even if we exclude this unusual positive effect, we still achieved operating leverage and a cost of services improvement of approximately 270 basis points compared to the previous quarter. Looking ahead, while we anticipate potential provisions as we expand our credit offering, we expect to maintain operating leverage in the core cost of services. Scotiabank analyst Juan Recalda inquired, can you provide insight into the potential drivers or positive surprises that could lead to better than expected margins in the third quarter? Mateusz Shearer replied, our margin dynamic for the upcoming quarter is expected to be consistent with previous quarters. We remain committed to driving efficiency and cost savings throughout the company, utilizing zero-based budgeting and implementing a shared services center. Additionally, we anticipate continued growth in our total payment volume, TPV, and merchant services business, MSMB. As a result, any outperformance in our top line should positively impact our bottom line as well. Goldman Sachs analyst Tito Labarta inquired, can you provide any insights on the potential impact of the elimination of revolving credit cards and the reduction of interest-free installments on your business? Pedro Zinner replied, it's too early to determine the impact of potential regulatory changes on our business. We are closely monitoring the debate and support changes that promote competition and benefit merchants and consumers. However, if installment transactions are restricted for merchants, it could have a significant impact on private consumption in the overall economy. Any modification to the interest rate of free installment structures would also greatly affect the industry. This could potentially lead to a decrease in private consumption, as the majority of credit transactions in Brazil are conducted through installments. It is possible that industry economics may need to be adjusted to accommodate these changes. Goldman Sachs analyst Tito Labarta inquired, could you please provide an update on the potential impact of a 100 basis point reduction in interest rates on our financial expenses and the potential risks associated with reducing pricing on prepayments in the current competitive environment? Mateusz Shearer replied, a 100 basis point cut is expected to have a positive impact of approximately 200 million on our P&L. This includes the effect on funding costs, floating revenue, and other financial income. Regarding pricing, we view it as a dynamic process and will continue to manage it in line with our target returns for new sales and minimal contribution margin hurdles in our client base. We believe the acquiring industry is behaving rationally, and all players have had to adjust their offerings due to the change in interest rates. Currently, no player, including ourselves, has known profitable offers by market share. Therefore, we do not anticipate passing on the benefits of declining rates in the short term. However, we will actively monitor market dynamics and adjust our pricing as necessary, as long as it meets our internal hurdles. Goldman Sachs analyst Tito Labarta inquired, can you please explain the reason for the significant increase in financial expenses this quarter, despite stable interest rates? Mateusz Shearer replied, certainly, let me break it down for you. The increase in expenses this quarter can be attributed to three main factors. Firstly, the growth in MSMB TPV, total payment volume, has contributed to these expenses. Secondly, we made a conservative decision to maintain a slightly higher cash balance during the quarter. Lastly, there was a slight increase in the duration of receivables sold. It's important to note that these expenses are primarily influenced by the TPV curve in the medium term. Therefore, this increase is specific to this quarter and not indicative of a general trend moving forward. Citi analyst Gabriel Gusan inquired, can you provide more details on the TPV slowdown in the market and its potential impact on MSMB TPV? Will there be a slowdown in overall TPV growth, even if you continue to gain market share? Leah Matos replied, regarding TPV trends, we did experience softer growth than initially forecasted, particularly in May, due to a deceleration in same-store sales of our clients. This aligns with the lower growth observed in the overall market, as reported by ABEX. However, despite this, we still achieved almost 4 times more growth than the industry average, while maintaining disciplined pricing. Our July data shows early signs of improvement, which gives us confidence in our guidance and our ability to continue growing above the industry and gaining market share. In terms of PIX, we have seen strong growth in PIX P2M within our customer base. The overall trend in PIX growth is similar to the market, with initial growth driven by PIX peer-to-peer and more recent growth driven by PIX P2M. PIX P2M is a payment method that we enable our clients to accept through a dynamic QR code at the point of sale, and we monetize it in line with debit card net MDRs. In the quarter, PIX volumes grew over 240% year-over-year. If we consider the consolidated growth of credit card TPV and PIX P2M, we see a yearly growth of 23%. While there may not be direct cannibalization of debit volumes by PIX, it is evident that PIX is impacting the growth of debit volumes. This trend is beneficial for us as we monetize PIX in a similar manner to debit cards, and it provides cost savings and instant settlement for our clients. Overall, we are pleased with the TPV performance and the opportunities presented by PIX. Bank of America Merrill Lynch analyst Antonio Ruette inquired, could you please provide more details on the drivers behind the increase in capitalization of expenses and whether this trend is expected to continue in terms of capex? Additionally, could you elaborate on the main execution challenges you are currently facing, considering the competitive landscape, the integration of links, and the introduction of your banking product? Mateus Shearer replied, in terms of capitalization, we made 2 key adjustments. First, we standardized the capitalization process for our software segment to align with our financial services unit. Second, we identified additional projects related to new features that were not previously capitalized. This resulted in a one-time positive effect of $21 million in the quarterly cost of services. Going forward, we do not anticipate these dynamics to repeat. Regarding capex, we saw a decrease from $416 million in the previous quarter to $332 million in this quarter. We expect slightly lower capex in the coming quarters, but it is not a general trend. Pedro Zinner replied, our strategy for the rest of the year is to focus on integration, cost discipline, incentives alignment, and streamlining our software portfolio. These will be the key drivers for short-term success. We also have priorities in place for top-line growth, so we are addressing both sides of our P&L. Improving our software business will take time, but we believe the rewards will be worth it. Our long-term goal is to build a unified commerce solution for our clients, with our software business playing a crucial role. We have a lot of work ahead of us, but we are excited about becoming the only end-to-end integrated software and financial services provider for Brazilian merchants. We will provide more details on our long-term KPIs and strategic view at our Investor Day in mid-November. I'll now hand it over to Leah for more information on our key initiatives. Leah Matos replied, we are pleased with the progress we have made on the banking side, as we have seen increased client engagement with our banking solution. Our combination of acquiring and banking offerings provides value to our clients by offering powerful cash-in options and addressing their main business pain points. We are actively working on enhancing our banking features to better meet our clients' needs. On the software side, this is a multi-year journey, but we have taken important steps this year in terms of organization, incentives, and prioritization. We have identified key verticals for cross-selling financial services to software clients and have implemented initiatives such as product bundles, integration, and go-to-market strategies. Currently, about 17% of our software clients utilize our financial services, up from 15% at the beginning of the year. While it is still early stages, we are seeing initial traction and are confident in the direction we are heading. Cantor Fitzgerald analyst Josh Siegler inquired, can you explain how you achieved a strong improvement in software revenue this quarter, specifically in terms of increasing the number of active locations and driving cross-selling between financial services and software? Leah Matos replied, we are prioritizing investments in growth in our software business, specifically in our less mature channels such as franchises inbound and inbound. These channels target the middle segment of the client pyramid, which we refer to as mid to large clients. This focus has driven the growth in our locations, and we will continue to invest in this area as it is strategically important for us to combine software and financial services to offer a stronger value proposition to our clients. We are also organizing our teams around cross-selling efforts, aligning our financial services and software teams to achieve this objective. We have structured initiatives around products, offerings, and go-to-market strategies. We are targeting verticals with the largest opportunity within our software client base in the overall market, focusing on verticals with a large total addressable market, TAM, and a relevant client base for us to tackle. We will provide more details on this at Stone Day in November. Cantor Fitzgerald analyst Josh Siegler inquired, can you provide an update on the timing for the rollout of the new credit card product and its potential impact on the banking segment? Leah Matos replied, thank you for your question. We are currently in the pilot phase of our credit card product and are on track to scale it by the end of this year. We are excited about the potential it holds for our business. Pedro, would you like to provide any additional details? Pedro Zinner replied, in our previous call, we mentioned our conservative and disciplined approach to expanding our credit book. We have been observing the performance of the full cohort and considering the current macroeconomic conditions. While we are still maintaining a conservative approach, we anticipate some scale-up in the next semester. As for our portfolio performance, it is too early to draw definitive conclusions, but the initial results are better than expected based on our models. HSBC analyst Neha Agarwala inquired, my question is regarding the MSMB segment. Can you explain what factors are contributing to your continued market share growth in this highly competitive segment? Additionally, are there any specific competitors from whom you are gaining market share? My second question pertains to the decline in active clients in the long-tail segment. Could you provide more details on this decline and clarify if your pricing strategy in this segment is more aggressive? How do you plan to maintain or increase your market share in the long-tail segment going forward? Leah Matos replied, our market share gains in the MSMB segment can be attributed to our focus on providing excellent service and owning the touchpoints with our clients. We have identified white spaces in Brazil where we can further grow our distribution and allocate capital and marketing to expand in the micro segment. Additionally, we have expanded our product offering while expanding our distribution footprint and maintaining the best customer service in the market. Our ability to optimize Ton and Stone offerings across multiple channels has allowed us to gain share in both micro and SMB segments with attractive economics. It is important for us to balance growth with profitability, and the combination of these factors creates a strong value proposition that attracts clients across different profiles. Leah Matos replied, yes, absolutely. In the first quarter, we implemented a strategic marketing campaign centered around Big Brother Brazil, a popular reality show in Brazil. This targeted campaign had a significant impact on our performance during that period. As the quarter progressed, the effects of this campaign subsided, resulting in the observed evolution in our numbers. Mateus, would you like to provide any additional insights? Mateus Shira replied, our client base increased from 2.7 million in Q1 23 to approximately 3 million in Q2. However, the rate of new client additions slowed down. This was primarily due to the impact of our first quarter marketing campaign, as Leah mentioned. Barclays analyst John Coffey inquired, could you provide some insight into the sources of the 19% MSMB TPV growth? Specifically, is this growth primarily coming from green space or is it taking market share from incumbents and newer fintechs? Additionally, considering the 3% sequential decrease in key accounts TPV, are we approaching a point where we can expect to see growth in this area? Leah Matos replied, our ability to consistently gain market share from competitors has been a driving force behind our TPV growth. This growth is also influenced by same-store sales growth within our existing customer base. By attracting new clients and maintaining strong relationships with them, we can continue to expand our market share. The competitive landscape has remained relatively stable, with no significant changes in the main players across different regions and client segments. Barclays analyst John Coffey inquired, is the pain over for key accounts in terms of quarter-over-quarter declines in TPV? Leah Matos replied, yes, we anticipate consistent TPV dynamics moving forward. This segment presents a valuable opportunity for us, and we expect stable TPV behavior. JP Morgan Chase & Company analyst Guilherme Grispan inquired, my question is regarding the competitive dynamics in the long-tail segment and the impact of chargebacks on banking deposits. Can you provide more clarity on these topics? Leah Matos replied, in terms of our micro segment, our focus is on strategically optimizing our Ton, Stone offering to maximize market share gains with attractive economics within the MSMB client segments. We structure our offerings in a way that attracts clients with healthy economics, particularly those with higher average TPVs. We have return hurdles for all client segments and products, allowing us to optimize the clients we bring in. As for the second part of the question on banking, I'll pass it over to Mateus. Mateus Shira replied, in the quarter, we experienced a one-off event that had a negative impact of 286 million in deposits, but it did not affect our profit and loss statement. This was due to a change in our chargeback and conciliation collection process. When we receive chargeback reconciliations from our Ton merchants, we use the funds to block the same amount from the merchant's outstanding deposit to ensure collection. During the migration to Superconta Ton, we settled these amounts instead of just reserving them, resulting in a one-time decrease in deposits without any impact on our profit and loss. It's worth noting that if we adjust our deposit base, we would have seen a 7.8% sequential growth, surpassing the 5.6% growth in MSMB TPV. This demonstrates the increasing engagement of our clients with our banking product. JP Morgan Chase & Company analyst Guilherme Grispan inquired, can you provide the expected credit loss ratio for this type of working capital product at maturity on a sustainable basis? Mateus Shearer replied, while it is premature to draw definitive conclusions about our portfolio performance, I can share that our model predicts an expected loss just below 10%. However, we are taking a conservative approach in provisioning nearly 20% due to limited track records and prevailing market benchmarks. It is worth noting that the performance of our cohorts has exceeded the model's forecast. As our portfolio expands, we will enhance our disclosure on credit performance for better tracking of progress. UBS analyst Caio Prado inquired, could you provide insight into the competitive dynamics in the industry, specifically regarding the sales force? Are you experiencing increased competition in this area? Additionally, what are your thoughts on your current sales force? Can we expect any expansion or reduction in headcount? Leah Matos replied, our model goes beyond just hiring salespeople. It's a combination of factors including our agents' involvement in the sales and client lifecycle process, last-mile logistics, customer service, and integrated technology. This integrated technology allows us to gain efficiency and provide intelligence in serving clients. The result is a high level of client satisfaction with both our Stone and Ton products. While competitors may try to copy our distribution aspect, our model is about more than that. With our technology, we have granular data that helps us identify local opportunities and allocate sales teams accordingly. Considering the vast geography of Brazil, we still see many white spaces where we can continue to grow. That's the message regarding sales headcount and dynamics going forward. UBS analyst Caio Prado inquired, can you please provide an update on the percentage of TPV from key accounts that is still attributed to the sub-acquiring business? Additionally, could you discuss the company's perspective on platform services going forward, including any focus or competition in this area? Leah Matos replied, we anticipate a stable TPV, total payment volume, outlook with a continued shift towards platform services contributing to our volumes. There are no significant changes expected in the dynamics going forward. We can provide additional details on the sidelines, but overall, we don't foresee any major deviations from the current trends. Itaú BBA analyst William Baranyar inquired, can you provide insight on the comparison between the take rates of the new cohorts of clients, specifically in the MSMB segment, and the current base? How does the average volume of these new clients differ from the current base? Additionally, can we expect an improvement in take rates by altering the mix of added clients? Leah Matos replied, going forward, we are focusing our hub operation on larger SMBs, resulting in higher average TPVs for these clients. While the overall average TPV may not reflect this trend due to the mix shift effect between micro and SMB clients, it is important to note that our strategic evolution within the SMB segment is centered around larger SMBs. This focus on larger SMBs is not reflected in the overall average TPV number, but it is a significant trend within our hub strategy in the SMB client segment. Mateus Shearer replied, thank you for your observation on take rates. The growth of the micro segment has had an impact on our take rates, as it is growing faster than the SMB segment. When comparing take rates between the previous quarter and this one, the mix shift contributed to a 4 basis point increase in take rates. Susquehanna International Group analyst Jamie Friedman inquired, could you please provide an update on the progress of the software integration following the Links merger? Specifically, could you share any challenges or setbacks that have impacted the growth trajectory and made it dilutive to current growth rates? Pedro Zinner replied, the decision to delay the integration of the acquisition was made in the past due to various factors, including the company's focus on entering the financial services business and the need to navigate changing interest rate dynamics. We believe this was the right decision given the circumstances. Currently, we are actively working on integrating the acquired business and have narrowed down our initiatives to provide better focus. We are prioritizing specific verticals and will provide a comprehensive update on our plans during our upcoming Investor Day presentation. Susquehanna International Group analyst Jamie Friedman inquired, Mateus, could you please clarify the level of provisions included in the operating margin of 15.3% at the midpoint of the Q3 guidance? Mateus Shearer replied, I understand your interest in our outstanding portfolio for the next quarter, but unfortunately, we are not able to disclose. New Street Research analyst Sumit Datta inquired, could you please provide the contribution of debit volumes and Pix P2M to Stone's overall performance? Additionally, considering the growth of P2M in the industry, which is in line with debit, would it be accurate to say that the current narrative around soft card volumes is misleading for acquirers? Lastly, if P2M remains relevant, would it have a positive impact on gross margins in the future, and possibly even on current gross margins? Leah Matos replied, the overall TPV growth for Pix P2M is expected to increase to slightly over 23%, compared to the initial 19% growth. This is due to the stronger growth of Pix P2M volumes. While we have not yet made the decision to disclose TPV including Pix, it is a trend that is here to stay in the market. We have observed early adoption of Pix peer-to-peer and more recently, increased adoption of Pix P2M. Moving forward, we will provide more information on this. Pix is a payment method that many consumers choose to use, and merchants may want to incentivize its acceptance due to the settlement characteristics and economics associated with these transactions. However, it is important to note that the usability of Pix is not yet at the level of cards. This is an ongoing evolution, and we will continue to monitor its progress. New Street Research analyst Sumit Datta inquired, just to clarify, is the current pricing of the product at the same level as Debit, resulting in a higher gross profit business currently? Mateus Shira replied, when we refer to price similar to Debit, we are specifically talking about the net MDR, merchant discount rate, of Debit transactions. This does contribute to our take rates, but it doesn't have a significant impact on our gross margins. Bank of America Merrill Lynch analyst Nicholas Riva inquired, can you provide an update on your ability to access the FDIC in the local debt market in Brazil? Additionally, could you explain the factors driving the increase in financial expenses despite total debt not increasing in the quarter? With the central bank in Brazil cutting reference rates, how should we expect funding costs and overall profitability of the prepayment business to be impacted going forward? Mateus Shira replied, in terms of our debt versus sale of receivable mix, we saw an increase in financial expenses compared to MSMB TPV due to a higher volume of receivable sales rather than debt. This decision was driven by better spreads for receivables in the quarter, but it is not a long-term trend. Looking ahead, we anticipate that financial expenses will align with the yield curves in Brazil and TPV growth, with potential positive effects from the decreasing yield curve in Brazil. Pedro Zinner replied, thank you for your participation on the call. We appreciate your continued support and look forward to providing updates in the next quarter. Have a great evening.